Welcome to the Market Mosaic, where every week we are looking at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near term. We are coming off a huge week for more stimulus. The Fed is taking actions to boost liquidity. It's going to loosen financial conditions further. So we know at their final meeting of 2025, the Fed cut rates by another quarter point. That was widely expected just before the meeting. We did see odds kind of flipping around a little bit, but just before the meeting, odds favoring a cut. It was the third consecutive cut since the Fed resumed cutting rates back in September. But the surprise was that the Fed also announced a fresh round of money printing. They're not going to refer to this program as quantitative easing, but it's very similar in that the Fed is expanding its balance sheet by purchasing $40 billion in treasury bills every month. And so this is going to go on for the foreseeable future. That balance sheet expansion is coming back the same month that quantitative tightening was ended. And that's where the Fed, for their balance sheet assets, for government fixed income securities held on the balance sheet, they allow those to mature without reinvesting the proceeds. That shrunk the Fed's balance sheet, but we're going the other way now. So we've got rate cuts, a fresh round of asset purchases, and that comes at a time when financial conditions are already running much looser than average. So that's what this chart on here shows. It's plotting a measure of global financial stress, and I took this back about 10 years. And a reading at this zero line on here, this represents the average of different factors that go into this index, looking at credit, equity valuations, funding volatility, and so on. And you can kind of see the cumulative effect of all those areas with this black line on here. And so when this black line is below zero, like it is right now, that means conditions and stress is less than average. Above zero is greater than average. And you can see we are running near the loosest level since this cyclical bull market started back in late 2022. So here's the thing. So we got this boost to liquidity. So there's very little financial stress out there. Now we're going to see another boost of liquidity. That's happening alongside what we've already seen with pretty solid economic growth. But we still have more fiscal stimulus that's coming next year. That's because of the tax and spending provisions contained in the one big beautiful bill. And so in my opinion, this is really a perfect storm of conditions to keep driving the bull market into the new year and see the S&P 500 at new highs. So but valuations are historically extended, so that means a positive earnings outlook is critical to support more gains in the stock market. So this week what I want to do is take a closer look at some of this monetary and fiscal stimulus set to arrive next year, with the stock market already hovering near record highs. And then I also want to look at some evidence that the average stock is holding up really, really well here. And you've got conditions to spark a rally into year end, but there could be a surprise with the Fed, a downside surprise with the Fed. I want to explain why I think the Fed could become a volatility flashpoint in 2026. I want to start today with looking at the impact of one big beautiful bill. So this is, in my opinion, a very overlooked source of stimulus that is set to arrive next year, because this is when a lot of these some of these provisions go into effect. That will be a big tailwind for the economy and consumer spending. So the bill includes things like increasing the standard tax deduction, increasing the child tax credit. There's new deductions for overtime pay, even interest on auto loans. If you look at everything that's in there, kind of the spending provisions and the tax cuts, taking everything combined, the CBO estimates that this is going to boost GDP growth by 0.9% in 2026. So adding nearly a percent to GDP growth in 2026. So this is a very significant source of stimulus that is going to be hitting the economy next year. The Fed is going to be a key catalyst for driving the stock market. It's no surprise. They're always a key catalyst for driving the stock market. But I think in this instance, they're going to be driving a lot of volatility. So look, the Fed's actions recently are good for the stock market. They're cutting rates, they're boosting market liquidity with the balance sheet expansion again. That's a good thing for the bull market. But watch as we get into the year, that narrative around the Fed, the positive narrative, could change as Jerome Powell's position as Fed chair ends in May. And that's because there is intense political pressure on the Fed to keep cutting interest rates. But it's hard for them to do that because consumer inflation is well above the Fed's 2% target. We've got consumer inflation at 3% right now. The labor market has not, it's slow, but it's not deteriorated as sharply as feared. And you still got measures of economic activity are holding up really, really well on top of all this stimulus, fiscal stimulus set to arrive next year. And so we're seeing a very growing divide within the Fed, and it's gotten to levels that Powell has not ever seen during his term. So what the chart on here shows is it shows where each Fed official, so the 19 officials attending the FOMC meeting, it's important to note that not all of them are voting members, but they still provide their projections and estimates on where things should be at. What this does is it looks at each official at the Fed's December meeting for 2023, 2024, 2025, and where the short-term Fed funds rate should be at the end of the year. And what you can see is, back in 2023, we had a unanimous decision on where Fed funds should be. 2024, start to see growing dissent. 2025, even more so. So you had 7 officials disagreeing with where the level of Fed funds should be at, with 6 of them thinking it should be higher and 1 thinking it should be lower. So, we're seeing these disagreements increasing, and that could inject a lot of uncertainty into the outlook for monetary policy. If there's one thing the market doesn't like, it's uncertainty, especially uncertainty with something as important as the Federal Reserve. And I think that's going to be a major theme in the year ahead. Following the Fed's decision to cut interest rates and to resume purchasing Treasury securities, we are seeing the U.S. dollar index take another leg lower. It's weakening once again. So DXY, that tracks the dollar against a basket of other securities, it turned lower. That followed a test of the key 100 low. So 100 is a key level it broke below. Earlier in this year, it came back to test that level, turning lower, and the downside's accelerating. So it's losing support at the 50-day moving average, the 200-day as well. Talked the other week about how the Fed's trade-weighted dollar index shows a dollar is still historically overvalued. So that supports weakening in the dollar. If DXY, if the dollar remains weak into 2026, I think that could be a huge boost for the commodity trades. And so what this chart on here is showing is DXY, the dollar index, is the blue line, and this red line is a ratio of commodities to the S&P 500. So when this ratio is rising, that means the S&P 500, when it's rising, that means commodities are outperforming the S&P 500. When it's falling, it means the S&P 500 is outperforming commodities. And you can see there's an inverse correlation here. When you have the dollar strengthening, that's associated with commodities underperforming the S&P. When the dollar is weakening, that's when you see commodities against the S&P 500 really start to take off. And we've had this period really since 2015 where overall uptrend in the dollar has coincided with this ratio hitting, some of the lowest levels we've ever seen. It's still hovering right there. But this is September 2022. It looks like we could have a very significant top end for the dollar index. And if we start to break below these recent lows, that could be a huge driver for commodities, especially given how undervalued commodities are right now relative to the S&P 500. So last week, we've seen some volatility in the markets, especially coming out of stocks leveraged to the AI trade, some of the mega cap growth stocks. They're waiting on the stock market. You've seen NVIDIA's trading near a 3-month low. Broadcom got hit last week. Oracle, same thing, been an overall downtrend. They've seen their stock prices in some cases look like they're absolutely imploding, but that is masking strength that we are seeing elsewhere in the market. So the thing is the sheer weight of NVIDIA and some of these other stocks on the indexes like the S&P 500, it's easy for those big names to drag the indexes lower. But in reality, what you're seeing is the average stock's holding up really well. So that was especially the case following the Fed's decision to cut rates and expand the balance sheet. There was a jump in the number of new highs across the market, and that is also taking indexes of the average stock out to new highs. And so what this line on here tracks, this is a line tracking the cumulative advancers versus decliners on the NYSE. So if you take on the NYSE any given day, you get a number of stocks that are advancing versus those declining. If you take that difference and add it to the prior day's total, you can create this cumulative line to track the performance of the average stock. And what I want to call out is that you really had the average stock peaking out back in September. you took that out just a little bit in October before reversing lower. But so overall, we've just had this sideways move in the performance of the average stock until last week. So we could be seeing a very significant breakout here in this AD line, where it really hasn't gone anywhere for, or hasn't seen a new high, a sustained new high for 3 months. So this is something to really keep an eye on, and it's a positive for the bull market. It shows really strong participation by the average stock. As we look to close out the year, historic stock market seasonality could play a key role in the final weeks of 2025, and we're tracking historic precedent pretty well. So, November marks the start of a strong 6-month stretch for the S&P, but we are struggling to get past the high seen in late October, but that's what you would expect with the first half in December. So the S&P is trading sideways over these last 2 weeks, the first 2 weeks of December. That does align with seasonal trends when you look back. So what the chart on here does is it shows how the S&P 500 has tracked on average during December using data back to 1950. So this line is just the average movement of the S&P 500 during December using data back to 1950. And you'll see that the first half, so you get through the first 14 or 15 days, tends to experience volatile sideways trading before strength emerges in the second half of the month. And so, with breadth really strong, with the Fed delivering this boost to liquidity, along with some other things, I think conditions do support a similar path this year. So watch for a rally to unfold in the second half of December and close out the year strong. One thing we do want to be mindful of right here, if you are a longer term investor, if you are a buy and hold type of investor with a holding period that is measured in years, you have to be careful buying at these levels and watch out for warning signs of a peak in the market, because valuations tend to be noisy over the short term. Especially periods 1 year and in, valuations don't really matter much to what the S&P 500 does 1 year and in, but valuations do matter a lot over longer term time frames. Well, so what this chart does is this plots the S&P 500's forward PE ratio versus what the S&P then does subsequently over a 10-year basis, looking at annualized returns over the next 10 years. And you see this nice downward sloping line. So what is this telling us? This is telling us when we buy at a low forward PE ratio, our forward returns, annualized 10-year returns, tend to be really strong. As that PE gets more expensive, the forward returns start to dwindle, and this red dot right here, this is where we are today. So this is the forward PE ratio on the S&P 500, is using earnings estimates over the next year. It's currently over 22. You can see once you get into an area over 22 or so, this is where you tend to consistently see forward returns in negative territory, especially if you start to go even higher from here. There's some instances up here where you're around 22 and the S&P still eked out an annualized gain over the next 10 years. But as you start to push further above that 22 level, you're pretty consistently in negative territory. So this is just, big picture, longer term, looking ahead. These are very concerning valuation levels on the S&P 500 for investors with a longer term holding period horizon. Week ahead, we have some very, very important economic data coming out. And this is really going to set the tone for what the Fed could do at their first meeting in 2026. And it's because we've had a lot of these data points getting delayed during the government shutdown. As long as these don't get delayed again, we are scheduled to get non-farm payrolls for the month of November and also CPI for the month of November this week. So, data points covering the Fed's two mandates of price stability and full employment. We know with these rate cuts the last 3 months, or the last three Fed meetings, Powell's referred to them as risk management cuts. They don't want to see non-farm payrolls deteriorate further, but we know CPI inflation has still been running pretty hot. So the focus has been on the job market. So keep an eye on that payrolls number. If you see payrolls coming in better than expected, you could see a quick shift to this inflation mandate. for the Fed. One name I want to keep an eye on this week is with I'm watching a lot of stocks in the mining space. So one in particular I'm watching is with Orla Mining, so ticker ORLA. And this is why do I want to watch this right here? It's because this is one that's still been setting up and just grinding sideways, so we could still have a potential entry point. Now we know gold, silver, the mining stocks have stayed pretty strong here recently, and so this is a tradable setup that I want to keep an eye on. And what I'm interested in is this stock came up to test this $14 level, made started to break out of this prior range, and then pulled right back. Well, we've come up to test that 14 level again, and now we're making a smaller pullback that's resetting. We get this bullish momentum reset with the MACD above the 0 line. So it almost looks like a cup of handle pattern if you've studied those before. But either way, what we're watching for is just to get a series of smaller pullbacks off that resistance level, because that points to accumulation in the shares. So if we can see the relative strength persist in gold, silver, and related mining stocks, I would watch for a breakout over this $14 level as an area that you could add a position. All right, that is all for this